There's a lot to talk about from the standpoint of what has happened since the administration has taken over, and the tariff conversation, and how that's had its impact on um, interest rates, or at least not so much interest rates as it relates to the Fed lowering rates, although that could be happening soon. But the 10-year Treasury and the 2-year Treasury has come down, at least some. I mean, there was, I think, a thought that it was gonna come down more, at the onset, but that's not necessarily happening for reasons that are probably a little more in depth, than this particular conversation. But, um, all of that plays, I think, sort of an interesting, um all of this plays a meaningful role in how we look at where we're going, moving forward. In the From a real estate standpoint, um, there's the conversation about how tariffs could affect the construction materials, and that's a very real consideration when folks are considering, what they're going to do. And development has been in a big, a problem spot, sticky spot, due to the fact that there's ULA still in place, although there's discussions about doing something with that. Um, but that's still happening. The land costs are still high, but coming down. The construction costs are still extremely high, and rents have come down, and so the margins are almost non-existent for developers trying to build new product right now. So that's sort of a background to the area, and to the environment. Although y- within all of that, there are some opportunities that I think are kind of like popping up, and one of which is that for those folks that did start building construction, of market rate units in the last couple of years, we're seeing that there's motivation in that asset class to potentially move that product at pricing that seems to be coming in line with where some of our buyers are opening the door to, and opening the opportunity of purchasing in the low five cap. So from our standpoint, a lot of our energy has been working with folks in that space. That's a place of real opportunity right now. So the newer constructed buildings, if you're a family office or whatnot, and you see opportunity in owning something that's new, that's definitely a place where we're staying very busy.
That's interesting. So you also talk about affordable housing in that space.
Yeah, that was another. So maybe in some sense, it has now filtered through the community that there were some projects that sold over the last couple of years, and they made headlines. They would say, the city of LA, through Project Homekey, purchased this property for $600,000 a unit, or $400,000 a unit, whatnot. And so that has permeated the real estate investment universe. And there are funds for project. There's a new project, Homekey. It's Homekey Plus, and the last round was interim supportive housing for the homeless population. And this next round that is coming through is actually in process as we speak, is for permanent supportive housing. And permanent supportive housing is a little bit different. It's similar, but it's a little bit different in that it's voucher based, and it's the intent obviously is to create a permanent, housing space. That process, I've helped a couple of clients write those applications on more than one property, and that process is exceptionally um, nuanced and detailed and complex. So it's one of those things that on the onset seems like this is a huge opportunity. The state of California said that there's $1 billion for LA County alone. Actually, it's over a billion. Um, uh, $1 billion for LA County alone to deploy capital into Homekey Plus projects. But the reality of that of deploying that capital from the state is proving to be exceptionally complex. And the challenge is that there's that complexity means that everything needs to line up. So you've got several different pieces. You've got vendors that have to be partnered. You have to have operators that are applying with the city. The city has to then select the operator. The operators have to have service providers or be a service provider. The service providers have to have existing contracts with, the Department of Mental Health or behavioral health or some outside service so that they can be paid to do their service. You need to have property management in place, and then every single one of those parties that is involved has to have prior experience at the level that's sufficient to match the project that you're working on. And so when you stack up all of that and then you layer on top of it that somehow the project has to have funding the for the permanent supportive housing in the form of vouchers, that's not always a that's not always a pre-existing condition. In fact, it's in the city of LA right now, it's very much so not a pre-existing condition. There are actually no vouchers being issued for project-based, real estate ventures, and that's a fancy way of saying that, the 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 investor community is largely reliant on the tenants just approaching them, on a one-off basis. And the state of California has basically said, we are not interested in handing you grant funds, 10, 20, $30 million grant funds, unless you can show us that you actually have the revenue to support yourself out of the gate. And so that means that the project has to have some kind of um, agreement for project-based vouchers. Now, I'm getting a little bit in the weeds here. There are entities, like the county, the LA County uh, Department of Behavioral Health does have funding for that if it's attached correctly, but you still have to apply for it through the Homekey window, whatnot. Um, this is a little bit of a long-winded way of saying it's exceptionally complex. And so it's a window that's available to a very few number of folks, and as a result of that, there's just not gonna be the amount of deployment that I think we expected to see on the front end. Doesn't mean it's not coming, but it's gonna work itself through a number of years, and the challenge with that, of course, is that if any one of the cogs, the funding cogs, kinda falls off, then we're stuck. Then there's this sort of half-baked version of a solution path that doesn't have any way of actually realizing itself. So, it's out there, and there are actually other grants that are very interesting and compelling right now too. The state of California issued one. We passed Prop 1, and, Prop 1 provided funding for permanent supportive housing, but also other types of facility, type of housing, and that's through the Department of, Behavioral Health or Department of Mental Health Services, DMHS, that is funding, what you would call the lock and key type, housing, solutions, and now that's maybe a little more, racy from a political standpoint because you're talking about more of a facility. That's for folks that have higher levels of acuity, and the fact in the homeless community is that on the front lines and the politics of homeless housing have a lot to do with permanent supportive housing and services and so on and so forth. On the backside of it, I think there's an acknowledgement that some of the folks that are out on the street are some is actually the overstatement of the day. 70% of the homeless population is either, suffering from long-term, serious, debilitating drug addiction and or a comorbidity with, serious, psychological distress. So, the 2 of those hand in hand, don't fit terribly well with the idea that a permanent supportive housing that it's independent and sort of like you and I would think of like, okay, here's your house. Go, now you go live. You won't be on the street because you got your own kitchen and you've got a refrigerator and you've got your own unit and your locked door and so on and so forth. There's a percentage of the population that's just not prepared for that level of independence, and so there are programs. Permanent supportive housing does address that to a certain degree, but when you deal with a more severe case, then there's a whole 'nother layer to this that's evolving, and there's funding for programs to address that as well. It doesn't get as the same level of, attention I think in the newsosphere, so to speak, but it's a fascinating part of the industry. It's definitely something I also, have worked on a couple of projects in that space. In fact, the if you recall, there was a property that we had listed on, 1920 Robertson, that big vacant 32-unit property. So, I helped we did close that project, by the way. We sold that property utilizing a grant. It was not a Homekey, it was through the CCE. It was the Community Care Expansion Program. State of California is the 3rd round. They've had this one around for a little bit. And, this was a $22 million grant, and the grant paid for the acquisition of the land and the asset, which was vacant and needed a lot of renovation. The seller did very well on the sale price, and we have the funds, necessary to run a complete deep rehab of the space, adding 3,600 square feet, so that's going to be a total of about 26,000 square feet that's gonna be renovated into a 120 bed adult residential facility, and that's again, that's one of those in the what's called the continuum of care that, for, residents who can maintain a certain level of independence in life, but also need some additional supports and services. So an adult residential facility is a degree away from independent living than like permanent supportive housing in that they provide meal service and there's a community kitchen and there's a community exercise room and so on and so forth. And then there's medical professionals on staff to deal with the mental health and some of the other issues. So
That was my question was what qualifies that? You call it a support center?
yeah.
Is there staff? There is an actual
Yeah, so a lot of the distinctions here when you're moving down through that continuum of care have to do with the staff to tenant ratio and the actual configuration of the units as to what a unit qualifies as and what is inside of it. So inside of an ARF, for example, there is no kitchen. There's just a living area and bathrooms. So that's those living areas are a little bit more, community oriented than an independent, like, permanent supportive housing, system.
That seems like a pretty I wouldn't say niche, but maybe it's kind of a niche thing, but it's the barrier for entry is pretty high. You have to have some sort of like a background in some sort of facilitated care where you
Right.
and that seems like a really, that is a niche, I guess, that's a very
It's absolutely a niche. I mean, it's a fascinating space to be in. I've been working in it now for about 3 years, largely because of this facility, but it's led to, a deep dive into the supportive housing and affordable housing, which includes the more traditional, what we call the LIHTC, style of housing, and that's, that style of affordable housing, for example, utilizes these tax credits and bonds that are issued, um, to help support the cost of the construction in exchange for some covenants that get put on the real estate so that it only is rented to folks that fit within particular, AMIs or, um, income thresholds compared to the community so that there's a way to intermix, different socioeconomic, conditions within a community. So
is there a big syndicate in LA that specializes in this or looks for these deals or specifically?
There's a couple. It's definitely, it's in the news now, so there's more folks that are looking at this kind of thing. Again, it's a very complicated, and nuanced, business model, and, some of the biggest challenges, again, center around, the bondholders don't want to fund projects that don't have a clear path to funding the income stream on the unit. So there's always still money has to still change hands, and so the again, that question about with those vouchers when you're in this world in permanent supportive housing or in the affordable housing space, oftentimes the discussion is about what sort of supports are in place. So if somebody is, very low income, then the property can't exist without what is a Section 8 voucher in a sense. And those Section 8 vouchers have to be issued by HUD as, you know, financed through HUD, but then filters down through the city and or the county, and of course, in a maddening sort of manner, it's funded through all of those things, including other nonprofits and the VA, and just about any place you could imagine, that you've got somebody who could issue something, well, some type of voucher, then you've got that angle too. So you don't have one source, you've got 10 that you've got to deal with in terms of how to get these things funded. And that is always in short supply. So, again, cobbling the funding source on the finished product is part of the process of getting it funded on the construction side. And so it's, again, endlessly complex and
Very little room for error, I suppose. Well, the
not a
application
lot
process.
there's not a lot of room for error, and that's what makes them, part of the problem is these projects are expensive, and one of the reasons they're expensive is there's so much bureaucracy that is, loaded into this stuff that everyone has gotta protect their efforts and time, and so and then the bureaucracy creates additional, levers for costs, because there's gotta be prevailing wages, and some projects have union requirements, depending on how the project is underwritten, which is a perfect segue as to, one of the problems with the ULA tax is that was a well-intended tax, for the construction of affordable housing, in particular to help the homeless. But very little of that money has been deployed, number 1. Number 2, it hasn't created the revenue that they expected it to because it's killed the public market or the market-based market, it's killed velocity in the real estate world. And and
The ULA tax?
the ULA tax, yeah, so the ULA tax is a tax on
The mansion
all
tax?
properties. Yeah, the mansion tax, but mansions are only a small percentage of the real estate that can be
Right,
created that's worth
right.
$5 million. So in essence, so if you've got a apartment building, right, or a industrial property or whatever, and it's worth $5 million, you're getting the ULA tax. The problem with that is that it wasn't written in a manner that calculates what sort of like the capital gain was on that. So it wasn't a terribly fair, it was a very populist kind of like, um, tax that was sort of like tax the rich to help the
Right.
kind of concept, which I would argue in its construction that's never gonna last forever 'cause those pendulums are gonna swing. And, anytime you write something where where you say, all these people can vote for it so that this one person can pay this. Here's my, it doesn't, it's not terribly fair. If if the distribution of the taxes is equal, then everyone has a right to tax themselves. But it's kind of weird to set something up where you got all these folks that can make a decision for, a person over there saying, yeah, that's the way we should do it. But having said that, the other big problem is that it was, even if it was passed that way, it wasn't written in a way that allowed for somebody, for example, to buy something at 4,500,000, let's say, and then have a change of circumstances and and this actually happened to I sold a building to somebody, and they purchased it for, like, 4.8 a couple of years ago, and then one of the partners, in the property, well, she actually they didn't pass, but she got to the age where she said, "I wanna retire. I bought this thing, and then COVID happened, and then, all of the challenges of the economy in the last couple of years happened," and then she wakes up one day and she's like, "I'm 80 years old. I'm done. I wanna be out of this." And the minor partner that had put her into it, um, said, "Okay, well, we'll put it on the market, let's sell the thing." They couldn't find a buyer for more than, like, $5.1 million. And so they would have been better selling it for 4.9, but for reasons I don't fully understand, they they yeah, so they sold it for just over $5 million, and they were subject to a, $300,000 tax. And so they didn't after, everything was said and done, I think she lost money, you know?
Oh, wow.
Yeah, and that's not that I'm sure that's not the spirit of the tax, right? It was like, "Oh, yeah, here, people can lose money on a deal like this." But it didn't account for that, and it also didn't account for, and this is why there's no new construction right now, it also didn't account for the developer that buys a piece of land for $3 million, puts a $7 million construction loan on the project, and then tries to sell the property at a profit, say $12 million, right? So now they're subject to a 5% tax. Well, that's if they actually achieved their goal and built the thing on budget, then they've got roughly a 20% margin, and but that's not what has happened in reality. So, but let's just say it did. And most developer margins, probably the right way to say this is most developer margins are about 10%, right? Under 10%, if you believe that. Um, so $11 million. So let's redo this math. We're going to start this conversation. Edit that other part. So the ULA tax is not well written from the standpoint of a developer who, let's say, for the sake of conversation, buys a piece of land for $3 million and then builds it for, let's say, 7 million. Okay, so now they're at $10 million basis. And, so for the record, believe it or not, when everything's said and done, most developers work on very tight margins. Oftentimes, a project like this is maybe going to be run about a 10% margin. So they're going to sell it for maybe 11 and some change, right? Maybe $12 million. You've got sales costs, holding costs, so on and so forth that get you in that space. So they're targeting, okay, we're gonna try and do about $1 million of profit, maybe a little bit more. Well, guess what? Now they have a $600,000 capital gain because at $10 million, the ULA tax goes up 5.6%. I haven't done the math, but that's, almost $600,000. So why would you take a $7 million loan out and risk $3 million of cash so that you can make
Not a chance.
$600,000?
Not a chance.
It's not logical. And that's the real challenge is that there's no room, to do anything. So you're not gonna that developer is out of business. They are not going to build. They're gonna hold on to whatever they have. They're gonna go do something else, but they are not gonna go build, new projects. And guess what? That project was gonna bring 100 units online. And now or 50 units, depending on where you're building it. But now those 50 units are not gonna exist, and guess what? Housing crisis getting worse. So, it's a frustrating dynamic when you try and muscle the world, to your will without letting the free market kinda do what it's supposed to do. The free market can be very frustrating at times, and it doesn't necessarily make it fair. But one of the things that I think history has shown us time and time again is it's the free market is not fair, but it's the best thing we have. And
Right.
the more we manipulate it and try to force it to do things in a coercive manner, the worse the unintended consequences is. Conversely, we can support the private markets to push, you can use policy a little bit to encourage, but I just feel like what is it? The olive, the olive branch is better than the stick. So or the carrot is better than the stick. When you use the stick, you get a lot of unintended consequences. When you use a carrot where you say, "Hey, if you build," so for example, the opportunity zone thing, that was really creative, right? Um, that was a tax policy, ironically, not to get political, but that Trump won, initiated the opportunity zone. And what the opportunity zones did, and this was all throughout the United States, and we've got a bunch of them in Los Angeles, and there has been some progress. I would argue that we need to do more in this kind of way. Was essentially if you it developed in an opportunity zone, and you held that asset for a number of years, when you went to go sell it, you would pay 0 capital gains. There was a 10-year hold period, and it sort of stepped down. So it gave a developer who went into an area that was identified as a location that needed more capital investment, it gave them an incentive to go there because if they developed the project, held it for a period of years, they could sell it and take the profits tax free. And again, so that's a carrot type of policy that, I would argue it will direct traffic. It will bring people to the table, but it brings them there voluntarily. And that's a very different thing when people say, I'm going to go there because policy has given us an opportunity versus the coercion of, you know, forcing us to do something because, we have to. I'll add in. Yeah,
Is there a way No, as I'm sure this is the answer. Is there a way to say, let's say you spend $10 million on a low income like an low income property, something that you're talking about.
right.
Is there a way to lobby that that tax is eliminated somehow, some way?
There's a lot of
Because those monies, because the ULA tax is earmarked for low income properties, right? Or low income programs.
correct, correct. So that is a hot topic right now. Um, I was recently, meeting with some of the guys over at Sola. And if you are not familiar, Sola is one of the largest market-based affordable housing developers in Los Angeles. They took the opportunity zone and they raised literally billions of dollars and have over 2,000, I think it's 2,400 units in construction, all using private capital almost exclusively. Private capital funded market-based projects that are, let me restate that. They're not necessarily market-based, but it's market-based in its financing. So private capital is building units that are servicing affordable housing needs, and they've done a fantastic job of creating a business model that does well for its investors by doing good for its community. So, it's not like there isn't a path in that private world. The reason I mention this is when we were talking, they're working closely with Mayor Bass and advocating for, and there's a lot of in the LinkedIn, space. There's a lot of advocacy for a exemption on the ULA tax for, there's people wanting it on multifamily and commercial, but what I feel like is gonna likely happen is that if you are developing affordable housing, then the ULA will not apply. Now, again, that's one of those policies that's a carrot type of policy. It's
Right.
unfortunate that there's such a big stick behind it. It's like if we didn't have that big stick, then we wouldn't have to offer that carrot. But having said that, it still is a movement in the right direction. Yeah, so to answer that question, yes, there is
Yes, there's
discussion.
a way.
All right, to
There's a discussion.
turn this.
And she didn't. She didn't suspend any of that for the wildfires, right? She didn't, because she talk about.
No, she was no, so as the ULA was there was discussion about, suspending ULA as it relates to the wildfires. My understanding is that the challenge is with ULA is that because it was a measure that was passed by a vote, that the mayor doesn't have the executive authority, I think,
Got it.
for a legal team. They don't believe they have the authority to be able to say, even though it won the popular vote, I'm just gonna, it's a bad law, taking it out. So it's gotta go back to the people. If we're gonna get rid of it permanently, it's gotta go back to the people. Having said that, she probably has the legal authority is to carve out a little exemption with like, "Oh, well, we didn't mean affordable housing." So I think that's why there's some movement in that, side of things.
Due process.
Due process, baby.
Just as out of curiosity, how long do you think this ULA is gonna last? It can't last forever. There's just no way. As prices go up and the lack of new builds
Right,
increases, what's gonna happen? Well, there's a gap here. There's a huge you're creating a huge problem,
right.
and it's only gonna get bigger unless something changes.
Yep.
And that's, I guess that's the, it's
Here's
just
how
hanging out
here's
there.
how it solves itself. Here's how it solves itself. Housing gets is supply demand. Housing continues to get constrained, right? Housing continues to get constrained, rents go up. Rents keep going up, rents keep going up. At a certain point, the underwriting pencils again, and you can afford to pay ULA. That's in a world where the housing crisis has reached a fever pitch.
Mm,
So it'll all work at a certain point. If you got to price it in, you just got to let the pricing's got to work itself out. Land values are going to have to go down or stay flat because ultimately we could build today all day long. If the landlords were willing to give away the property at, at the valuations that they were at 15 years ago, we'd be off to the races. But that's not how markets work because, it's voluntary. Sellers of land, they have capitulated, prices have gone to come down considerably, but there's a certain price where they just say, "No, I'm not being hurt right now." Most landowners, either there's some existing, building on the property that's paying for the ownership, or they own it in cash, and it's been a long-term asset that they've had for a long time. They made a, strategic purchase. And so there's no real need to sell, a piece of land. It doesn't have if it's raw vacant land, it doesn't have tenants. It doesn't have problems. And so from that standpoint, there's the need to sell is based on greed, on price. And so
yeah.
if you don't reach that critical, number, and if they're stuck with that idea in their head, they're like, "You know what? I had an offer for $7 million, 2 or 3 years ago. I should have taken it, but I'm not gonna take your offer for 4. Not when I know in my mind that once upon a time, somebody offered me 7. Would you do that?" Right? I wouldn't do it either. I mean, it doesn't
But
make
like
you
you
a bad
said,
guy.
it's voluntary, and there's without getting political, there's one other way this can go, and as things become involuntary, and hopefully that we never ever get that point.
Well, for the record, there it was a measure. I just read that it got tabled, but there was a measure in Crazy Town. So again, I try not to get really political about this, but like, so there is a measure in the California state legislature where they were putting forward a bill that said, if you're a landlord and you own commercial property, we are going to fine you if you have a vacancy in your commercial property.
That's
That's
crazy town.
weird. I mean, it just it completely undermines what is happening there, If no one's willing to rent the space, the landlord has to be willing to accept a rent that is acceptable to them because there is risk in taking on a tenant. There are some units all through Los Angeles Talk about a regional problem. All through Los Angeles, there are two-story buildings that were built in the 1950s and 60s that have retail on the ground level, and they're storefront retail. There's the typical building is this. It's this storefront retail building like on Venice Boulevard, Washington Boulevard, any of these, Pico, whatever. Storefront retail, limited parking from the back, access through an alley, and you have office on the second story. And throughout LA, that office vacancy, I'm shooting at the hip here, but maybe 50% vacancy. The entire city has vacant office above their retail, above the retail, around the region. There's not enough office there's not enough office users to fill that space from the standpoint of who that person is and what that rent would need to be. And there's not a lot of landlords that'll say, "I'll take 50 cents a foot. Just whatever. Let's just do it." Because there's opportunity costs, you know? And
Yeah.
maybe that's not even maybe that still wouldn't rent. It's hard to really know, but there's a ton of buildings like that. And you could convert it over to residential. And I'm working with clients that do this, right? So we're looking at ways of doing this type of thing. But when you then have to backwards map. I had to send this email to a client the other day. I said, when you look at the cost, and the time and the entitlement risk, and you have to look at all of that needs to get done, and then you got to get to a finished yield that makes sense. You've got to get rewarded for all that work. And in a world where everything costs as much as it does, and the time and the bureaucracy and the permitting, all of that expands the time and the risk because it's not a shoe-in. It's not guaranteed that you get any of this stuff. You have to go through the process. And it's all well-intended processes. We've created a lot of rules over the last 100 years to make sure, people are safe and buildings don't explode and, so on and so forth. But we've legislated and we've bureaucratized the process of trying to make changes to our physical built environment that make it almost impossible to do it in a manner that isn't just prohibitively expensive. And so that seller who says, "I want X amount of money for my building," I get it. I can feel that it's worth this much. And you go, "It's not," because there's all this work that needs to be done to undo half of the building that doesn't have a natural, end user. There's no way to fill that space.
Mm.
And that's a big bummer. There's a lot of real estate that looks and feels like that.
That is a big bummer, but I would imagine in the near future that to rehabbing those to residential is gonna be a big project or a big deal, a big push.
It's a big little deal. It's lots of little deals because, most of these buildings, you get like 2 units out of it,
Right.
and
Yeah.
then the question is who wants to live over retail?
Right.
And that's another big problem is historically speaking, the tenant profile, you do all this work, and you got this brand new unit, and then the tenant profile that says, "Yeah, no, it's really cool. I love living in front of a busy street over underneath a business with this little thing, and I got one other tenant, and it's like it's just like sort of an oddball."
I'm getting visions of Brooklyn in the late '70s.
Yeah.
That type of style of living, that type of living over
Right.
the noisy.
You never know. Maybe we need to just change our orientation around that because actually it'd be quite nice if you had a cafe down below you.
Yeah, right.
Just
Yeah.
you don't need to eat anymore.
In light of that, what other opportunities are you seeing out there? What else is going on? How else are we being diversifying?
Yeah, we've gotten very diverse, and in a market where we've had the sale transaction drop by about 80%. One of the things that we have seen is one of the reasons why buildings are having such a hard time selling, and we see this in the data. So as the market has kind of found its bottom, it's really interesting to watch the cap rate to GRM trends. So if you are just measuring the cap rates, then what you see is that the market sort of hit its low last year in January, like the first quarter of 2024, um, pricing got its most attractive, nearing close to 6% cap rate on most of the deals that we're trading, or at least regionally. If you take a big, a sort of a wide map in the greater LA market that we work, which is kind of, in core LA, west of downtown. Um, and then you see it sort of gently sliding down, and now we're in sort of like the mid to low 5 cap, and that would suggest that, hey, pricing's getting better. But what you see when you look at the GRM, which is the gross rent multiplier, and I think we've done some primers on this, and that's the total income that the building produces as a ratio of its value. So when you take the GRM and you measure what's happening on pricing, GRMs are going down. Well, normally, if cap rates are going up, then GRMs should be going down. But cap rates have come down, but GRMs have gone down. So cap rates are the net income. GRM is the gross income. So and this is almost part hypothesis, but it's also vetted out in our discussion with our investors, both on the sell side and the buy side, and uh, conversely, in addition to that, what we're doing with our time is that there's an acknowledgement and the reality that a building that was built in 1950, 1960s, those are 60, 70-year-old buildings today. And those buildings need work, and their operational costs keeps going up. So insurance, outside of the how old the building is, insurance has gone up by 2.5 times within the last 5 years. We're at 2.5x of where we were underwriting before. It probably took some time for underwriters to catch up to the reality, and so that expense has gone up. Other expenses, other utility costs, the trash, the city of Los Angeles sort of consolidated their trash collection service. That tripled the cost of expenses. That probably goes back to sort of pre-COVID area. But again, all this stuff starts getting reflected in the long-term operations of the property. And so overall, you've got buildings that just cost more to run, and then there's an acknowledgement that they just cost more to fix now because you've got, higher material costs, higher labor costs, and they're older buildings. We are seeing, for example, that buildings are not changing hands. So even if you do want to sell your building, insurance is coming in mid escrow and saying, you're going to have to change your electrical panels because they're, what it used to be a red flag in the due diligence. Now insurance is saying, no, we won't underwrite a new policy if you don't change those panels out. And that can be very problematic if you're a seller because A, you got to get that work done. But when the real challenge is if the insurance company says, actually, we need you to change the main panel. Well, depending on the size of your building, the main panel, that can take a year for the materials to be manufactured. It's such a backlog for steel boxes that hold, switches in it that that can take months and months and months, even over a year, depending on the size of your building and the size of the panel that you need. So these are major considerations, right? There are other expenses that we're seeing too. We've seen buildings that have had, degraded foundations. We've seen buildings that have had, just there's so much work to be done inside these buildings. So that has been a big area of focus for us is helping and consulting with our clients that are either planning to hold the building or planning to purchase the building, or if they're on the back end of their ownership and they're looking at what do they need to do in order to sell, we're helping them orchestrate that side of the project. So we've helped a number of our clients in the last couple of years actually run the construction project either from the standpoint of after they buy it and they need to bring the building into compliance or to renovate it, or uh, pre-sale renovations that are necessary. in order to avoid massive, price concessions. We get in there and we start addressing some of that stuff. So much so that I even got my contractor license. I mean, because we just started doing so much work in this space that it made sense to try and sort of scale that side of the business out a little bit because it's absolutely everywhere.
So that's a good opportunity too, is vertical integration with expanding your business types.
Well, yeah, I mean, if you haven't noticed in that diatribe I gave you about, affordable housing, I love a good project and complexity seems to be my friend. It's meaningful for me as a guy who got into brokerage from the standpoint that I wanted to do development. It's really great to be able to come in and help clients all the way through the process, whether we're dealing with leasing or tightening up. We've helped clients in the past where they've had tenants that didn't have leases in place. They've just like, "Oh, my mom, she ran the building like this, and we inherited it, and it's got all these, it's got tenant issues." Well, we've gotten in there and help them structure their leases, get everything squared away so that when we went to put the property on the market, everything presented well. And today, we were doing this 10 years ago, but we're not at the same level of coordination and organization. And today, we can come in and really sort of look at a property from a very holistic standpoint, and basically solve any problem that a landlord has today in terms of what are they going to do with their property, whether they're holding it, they've just bought it, or they're getting ready to sell it. We can come in and sort of project manage that process into sort of a stabilized, a property.
Very cool. That's awesome.
Yeah, it's fun. If nothing else, it's fun.